Hey guys, so in this video, I'm going over my 6 top stock picks for the month of December 2020. After looking at hundreds of stocks, this is my list of stocks to check out for some big gains. Be sure to watch all the way through to get my full analysis on each of these companies. I'll go over their metrics, I'll go over their recent news, and the potential growth. Big shout out to Track Your Dividends for sponsoring this video. So let's get started. First on my list is DRAFTKINGS, stock ticker DKNG. This is an American daily fantasy sports betting website. They're the official daily fantasy partner of the NFL, and they were started in 2012. Right now they are trading at $52.75 with a 52-week low of $10.05 and a 52-week high of $64.19. So obviously this is a stock that has grown tremendously in the recent months. If we take a look at their 1-year price chart, you can see that they were trading for around $10 at the end of last year. They saw a brief jump to almost $20 a share, went back down, and then since then it's just really gone up. This is quite a volatile stock, so you will see a lot of ups and a lot of downs. But yeah, absolutely tremendous growth in this last year. This is a very speculative stock, and many of their fundamental numbers just don't make any sense. They have a market cap of $20.663 billion. They don't have a PE ratio or earnings per share, and they also don't have a dividend. They don't have a PEG ratio, but they do have a price to book ratio of 9.86. And profitability-wise, they are not doing well. Their profit margin is negative 143.43%, and the return on equity is negative 61.81%. Definitely things that would throw off a lot of value investors. One thing that is good is their balance sheet. They show total cash of $1.14 billion, and they have a current ratio of 2.9, which is very strong. This means they have almost 3 times the current assets as current liabilities. It's always great to see what analysts are saying, so on a scale of 1 to 5, 1 being a strong buy and 5 being a sell, DraftKings is currently rated as a 2.2, meaning it is a buy. And the current analyst average price target is $60.27, which is about 15% higher than the current price of $52.75. There's no denying that DraftKings stock is quite expensive right now, but is it trading at a premium compared to where it could be next year? The big reason why there's a lot of hype for the stock is because of the growing sports betting industry. About half of US states have legalized sports betting, and DraftKings is operating within about 10 of those states. So for me, I am pretty optimistic about the sports betting industry. I don't think it's something that should be banned as long as specific procedures are in place preventing people from losing their life savings. I also do think that sports betting is a game that more and more people are getting into as the taboo of gambling goes down. In recent news, DraftKings was announced as the official sports betting partner for Mike Tyson's boxing match versus Roy Jones Jr., and more events like this will set DraftKings as the standard for sports betting. DraftKings is forecasting revenue growth of 40% over the next year. The company also has had better than expected Q3 numbers. For example, a loss per share of 57 cents instead of 61 cents as was expected. They also saw $133 million in revenue versus $132 million that was expected. They also saw its monthly unique payers surpass 1 million, which is a 64% increase from last year. Now, in terms of its 2020 fiscal year guidance, they've set it at $500 to $540 million and $750 to $850 million for 2021. I'm positive more and more states will allow online sports betting. And with DraftKings getting a good market share in the industry, I think it's poised to do very well long term. Yes, it is very expensive right now, so you must be very careful. If there is a pullback, then that might be a really great time to get in. But long term, this should still be a good stock to pick up in December. Next up on my list is WORKHORSE Group, stock ticker WKHS. This is an American manufacturing company that specializes in EV delivery and utility vehicles. In the past year, their stock is up 800%, and it's one of my more speculative picks I'm investing in currently. Right now, WORKHORSE is trading at $27.18 with a 52-week low of $1.32 and a 52-week high of $30.99. We can see that just half a year ago, they were trading in the low single digits. And since then, they have gone up an insane amount, with the biggest jump in June when they saw almost 10x gains with a little drop and then another big gain with a big dip and then back up again. So yeah, this is also very volatile. WORKHORSE has a market cap of $3.276 billion, and they don't have a PE ratio. Their earnings per share is negative $2.65. So no profitability for this company, and they also don't have many stats to look at. Their balance sheet shows total cash of $80.22 million, and they have a current ratio of 0.75, which is pretty weak. As far as what analysts are saying, they are rating WORKHORSE as a 2, meaning it is a buy. However, the current analyst price target is $23.80, which is about 15% lower than the current price of $27.18. So you might be thinking, wow, those are some insane numbers to be investing in WORKHORSE. And yeah, you would be correct. The main gamble with this stock is that it could, in my opinion, be a $70 to $100 stock in the event that a certain contract is announced. Now, we don't know for certain when or if this actually is going to happen, but there is a lot of talk that the United States Postal Service and WORKHORSE are working on a 165,000 unit, $8 billion contract to provide USPS with delivery trucks. Now, I am seeing mixed reports, but it's certainly undervalued in respect to how other EV stocks have been doing. And if a USPS contract is set, we could see prices double overnight. But with the speculation definitely comes a lot of risk. You need to be okay with the stock being cut in half before it sees any huge gains, which could happen. We just really never know. So if you're big on EVs, you'll know that many of these companies are massively overvalued as of right now. The revenues simply do not back up the market caps. But what is driving those prices up is the future outlook of the EV industry. For example, California is aiming to have only a new EV car sales by the year 2035. And other states are planning on having this even earlier. Now, WORKHORSE doesn't have the numbers to back its valuation, but it is a leader in the electric delivery van space. To me, it seems like one of the top 2 contenders for the contract. It still is very, very risky, so I encourage you guys not to invest a lot unless you truly believe in it. Like I said, it's possible for it to drop all the way to like $10, especially in the short term if there is no contract given. But if that does happen, that is going to be a tremendous buying opportunity. So yeah, WORKHORSE is one of those stocks I am gambling on, but in my opinion, it could be a good bet. Okay, so I just want to take a quick second and thank this video's sponsor, Track Your Dividends. Track Your Dividends is a free platform that helps you track your dividend income. When you sign up, you'll be greeted by the main portfolio summary. Here, you can view all your holdings as well as your total portfolio value, dividend yields, yield on cost, and annual dividend income. Their software also provides other useful information on your portfolio like stock and sector diversification, an upcoming dividend chart, future value analysis, and portfolio alerts. They also have a premium version that gives you access to their stock analysis dashboard with premium tools like their PE analysis, price to book analysis, and dividend safety scores. You also get access to their popularity tool that lets you see a list of the most popular stocks being traded on Track Your Dividends. It's super affordable at $5.99 a month or $59.99 per year. And you even get a 7-day free trial if you sign up by using my link below or by typing trackyourdividends.com/Charlie. Next up on my list is Facebook, stock ticker FB. This is a social media platform that everyone has used for the past decade. They own businesses like Instagram, WhatsApp, Oculus, and a lot more. And they're basically one of the world's largest advertising platforms as well. So if we take a look at Facebook stats, right now they are trading at $277.81 with a 52-week low of $137.10 and a 52-week high of $304.67. Looking at the price chart, we saw a big dip when the pandemic started, but since then it's recovered quite well. Facebook has a market cap of $791.283 billion, a PE ratio of 31.65, and earnings per share of $8.78. And they don't pay out a dividend. Their 5-year PEG ratio is a very low 0.9, which is very good. And they currently have a price to book ratio of 6.52. Looking at the profitability, it's quite good for Facebook at 32.01%. And they also have a very great return on equity of 23.88%. Facebook's cash flow is extremely good. They have total cash of $55.62 billion, and they have a current ratio of 5.51. Analysts set Facebook as a 1.8, meaning that it is a buy, and the current analyst average price target is $314.96, which is quite a bit higher than the current price of $277.81. For quarter 3, Facebook's revenue was up 21% from the same time last year to $21.5 billion. Its earnings per share is also up 28% to $2.71. A lot of this growth is due to its crazy advertising revenues, which I think has more and more potential as everything shifts online these days. So the fact that people are staying home more and are more reliant on social media means that this is the best way to advertise for the millions of companies in the world. I talked briefly about this, but Facebook has a pretty great return on equity. Basically, this shows how effectively a shareholder's capital is being reinvested. So with an over 20% return on equity, this means that for every $1 in shareholder equity, Facebook is making 23 cents of profit. Right now, about 42% of the world is on Facebook. And one reason why some analysts are a little bit hesitant about Facebook is that the remaining population may not have access to the internet. And this can mean that user growth could slow down. It's definitely been rising steadily and active users are also up as well, but some say that there's not that much room for it to grow anymore. I will say though that advertising on Facebook is still in its early stages. With the growth of e-commerce, these industries are heavily connected. Online companies look for the best ways to advertise, and social media remains the best way to do so. I'd also encourage you guys to check out Google since they also own YouTube, and that advertising platform is going to grow so much as well. But their shares are super expensive, but hey, there are brokerages that let you own fractional shares, or if you have the money, definitely consider buying some full shares. The percentage of companies advertising on these platforms is still very small, and there is a lot of untapped market for this, especially as businesses are transitioning online, driving up bids for advertising space. Also, Facebook has yet to monetize WhatsApp and Facebook Messenger, which I think could increase revenue significantly. Don't underestimate the power of advertising. Facebook is in a position where it owns 4 of the 6 most visited platforms in the world, and with that comes a lot of future revenue. That's why I think Facebook is a great long-term pick for any stock investor. All right, so next up on my list is CVS, stock ticker CVS. So an interesting fact is CVS was originally named Consumer Value Store. They sell prescription drugs as well as general merchandise, and they also own over 1,000 Minute Clinic medical clinics in the United States. Currently, CVS is trading at $67.87 with a 52-week low of $52.04 and a 52-week high of $76.44. They were definitely hit hard by the pandemic, seeing a slow recovery, but dropping back down in August and September of this year. However, we did see a huge increase in price in November. CVS has a market cap of $88.836 billion, a PE ratio of 11.22, earnings per share of $6.05, and a mild dividend of 2.96%. Their 5-year PEG ratio is 1.16, and they have a price to book ratio of 1.27. This is actually quite low, meaning that this stock is priced pretty well right now. They have a profit margin of 3%, a reasonable return on equity of 12.06%, and a current ratio of 0.95. As far as what analysts say, right now they are rating this as a 2.1, meaning it is a buy. And the average analyst price target is $81.71, which is quite a bit higher than the current price of $67.87. I think that there is a lot of upside in the stock, but it's not going to explode in value like some of the more speculative ones. However, in the long term, we should see some great growth with CVS. We recently saw a drop in the share price when Amazon launched a rival online pharmacy. I mean, I see why investors reacted, but in my opinion, they just reacted a little bit too much. CVS isn't just a store that sells pills. Their merger with Aetna means that they are an integrated healthcare company that's doing much more than just pharmacy sales. They have physical clinics that attract people into their stores where they will buy other stuff. They also can do a lot of in-person services that are just not possible online. For example, they've been administering many vaccines recently, and they will be for the next year as well. By the end of Q3, CVS's revenues were up 3.5%, and their earnings per share was also up about 15%. They do have a good amount of debt due to their Aetna acquisition, but their balance sheet is improving and their cash flow is really great. Another bonus is their mild dividend of around 3%, which seems to be super stable as they're only paying out about 28% of their profits. I think CVS is a great value pick for long-term investors who want to invest in a solid company. You won't lose your money, there's no chance of that happening, and the long-term prospects of CVS are looking quite good in my opinion. Okay, so next up on my list is Walmart, stock ticker WMT. This is a multinational corporation that operates physical stores selling physical goods and groceries, and they also have an expanding e-commerce platform. They have over 11,000 stores in 27 countries, and you've probably shopped at many Walmarts in your lifetime. So right now, Walmart is trading at $151.60 with a 52-week low of $102 and a 52-week high of $153.40. So basically, we are trading almost at the 52-week high. If we take a look at their 1-year price chart, you can see that they weren't hit especially hard by the pandemic, and since then, we've seen sort of a bumpy ride back up to $150 per share. Walmart has a market cap of $429.597 billion, a PE ratio of 21.88, earnings per share of $6.93, and a very mild dividend of 1.42%. Their 5-year PEG ratio is 3.97, and they have a price to book ratio of 5.23. Their profit margin is 3.6%, and their return on equity is 24.13%. Walmart is holding total cash of $14.33 billion, and they have a current ratio of 0.83, which actually is kind of low. So analysts are saying that Walmart is a 1.9, meaning it is a buy. And the current analyst average price target is $161.44, which is about 6% higher than the current price of $151.60. So Walmart's Q3 earnings were very strong, beating expectations by analysts. This was due to the fact that people are buying a lot of things online now, and their e-commerce sales have just gone through the roof. The fiscal quarter ending October 31st saw an earnings per share of $1.34 and revenues of $134 billion. I think Walmart is in a really unique position because they are really well developed on their e-commerce side, having built it heavily over the last decade. And while e-commerce is growing, people are still going to want to shop in person. So this combination of assets will be a safe bet for the future. Perhaps they might trim down on their physical stores in the future and just continue building their e-commerce platform, but really, who knows? Their stores are still performing very well, with same-store sales up 6.4% for Q3. I've talked a lot about stocks like Shopify, Etsy, and Amazon as very strong e-commerce companies, but fewer people realize that Walmart is actually doing quite well in the space, and they have potential to take even more market share. That's why I think Walmart is a great stock to buy for investors that are looking for a reliable and potentially undervalued stock. It's bulletproof, and while it won't offer sky-high returns, it's definitely a solid buy with long-term upside. And next on our list is Tesla, stock ticker TSLA. This is our favorite EV stock, and with the way that Tesla has held the EV car industry, this will likely be a $1,000 stock in the next few years. Although I do like the company, I know that a lot of value investors are going to look at their numbers and be like, why is anyone investing in Tesla right now? So Tesla is trading at $585.76 with a 52-week low of $65.45 and a 52-week high of $598.78. Now this is a little bit confusing because there was a stock split, so a share was never actually worth $65. But if you account for the split, then yes, a stock was worth $65 for these more diluted shares. Tesla has seen a huge run up in the last year. It's one of the best performing stocks out there, and it just continues to beat expectations. They have a market cap of $555.24 billion, a PE ratio of over 1,000, and an earnings per share of 52 cents. Their 5-year PEG ratio is 0.97, and they have a price to book ratio of 28.95. Tesla's finally profitable. They have a profit margin of 1.97% and a still very low return on equity of 5.59%. They're sitting on $14.53 billion in cash, and they have a decent current ratio of 1.63. So obviously Tesla has seen a huge run up recently, which was much higher than I would have expected. With the recent news of the S&P 500 inclusion, we all know that this could really drive up the price even more. Tesla is such a big company that they're going to make up over 1% of the S&P 500 in terms of market cap. So what that means is that a lot of Tesla stock is going to have to be purchased to be put into these funds, which could drive up the price even more. Tesla is always overvalued for its current numbers. The reason why people continue investing is because of their future ability to take over the EV market. And this industry is expanding like crazy. I will say we probably will see some swings in the price, so I wouldn't invest in Tesla short term just with how volatile it is. For example, its beta is 1.97. But long term, I can see patient investors who hold Tesla for a long time making a lot of great money. Electric vehicles are all the hype, and whether that's a good thing or a bad thing for these stocks, I will let you decide on that. In recent news, Elon Musk says that the Tesla semi-truck will go to 621 miles per charge, and their market cap blew past Berkshire Hathaway in market value. Just crazy. If you trade stocks in the last month, chances are that you trade Tesla because it is one of the most heavily traded stocks out there. People are basically rushing in to buy it before index funds have to buy $50 billion of shares in December. Now, other EV stocks are going up massively, but I focus on Tesla because it is a safer bet. However, it really depends on your investing style. But yeah, for me, Tesla, it's a long-term hold, and I'll always be adding more and more of it to my portfolio. Anyways, those are my top 6 stock picks for the month. Now, before you guys invest, I want to say you guys have to do your due diligence before buying anything. Don't watch this video and just be like, okay, I'm going to buy these stocks just because Charlie said so. And what you want to do is you want to take this information and use it to kickstart your own research. Be careful, you guys, because the stock market is pretty crazy. It's at all-time highs. And in my opinion, it's starting to look a little bit like a bubble. I'd recommend don't put all your money in right now. Rather, just put money in slowly and just dollar cost average. That way you'll minimize your risk when it comes to investing. Anyways, thank you so much for watching. Thank you so much for your time. And if you guys like the video, make sure to hit that like button and subscribe to see more videos just like this. I make a ton of content about personal finance, investing, and entrepreneurship. I'll see you guys in the next video. Peace.